One of the lessons we've learned from the 2020 bull market is you cannot disaggregate the price performance of cryptocurrency with the Fed monetary policy. During the massive bull run where Bitcoin went to $68,000 and Hex went up to 52 cents, the big argument was whether or not Bitcoin and other cryptocurrencies were tied to legacy markets. So there was one side that said it was a hedge against inflation, and the other side was to say cryptocurrencies were a speculative asset. They had low liquidity and they were basically leveraged to traditional financial markets. And obviously, time is the biggest teller of truth. It is the biggest revealer of what is right and what is wrong. It seems very clear by now that cryptocurrency is in fact not a hedge against inflation. A lot of people thought Hex was the exception. At this point, it would be safe to say that yes, while Hex is not directly correlated with Bitcoin and Ethereum, it does require a dovish Fed in order for it to perform well, just like every other cryptocurrency and stock. If you think about it, it makes a lot of sense that Hex isn't going to do well in a tight monetary policy. Since Hex made all-time highs, it was still during an easy Fed monetary policy, meaning Bitcoin was able to go back up to its all-time high following Hex's peak. Now that the Feds have tightened and people do not have gains from other cryptocurrencies, they cannot buy into Hex with the same amount of money that they had previously. Even if it's not correlated to Bitcoin and Ethereum, it still requires a lot of money to be in the system. And since there isn't, we see right now it is not performing well. So with that being said, there is currently this fear out there that due to the Federal Reserve tightening and raising interest rates, we are going to go into a massive recession. The crypto markets are going to fall more. The stock market is going to continue to crash. People are going to lose their money. And the Fed is not going to be able to slash interest rates due to the inflation, due to the high inflation. People think that this is going to go on for a long time. They're selling their stocks, they're selling their crypto, they want to be in cash. The most important thing when approaching the markets and things like that is to have a level head, is to be able to understand things and think clearly. We know that the current downturn in stocks and crypto is because of the Federal Reserve adopting a tight monetary policy in which they are basically raising rates, which means selling the bonds and the mortgage-backed securities on their balance sheet, which is taking liquidity out of the market and making it more expensive to borrow money. So what causes inflation? People think that inflation is caused by the printing of money, by solely the printing of money, more money going into circulation. That is not true. In fact, just due to the low interest rates and the heavy borrowing, the money is increased over 11% every year. When people borrow money to buy houses and to buy stocks and things like that, the money is created out of thin air. That's what they mean when they say fiat is backed by debt, because it is created out of thin air for loans, which the promise is that it will be paid back, blah, blah, blah. So what causes inflation? It is not solely the increase in the money supply. It is the increase in the money supply plus an increase in the velocity of that money. Is inflation caused by the rich? The answer is no. Whether we are in a bull market or whether we are in a bear market, the rich people have the money they need because they have cash flow from either their high-paying job or from the income-generating assets they own, like real estate, dividend stocks. They generally have the cash need to buy things. So whether we are in a bull or bear market, their purchasing of goods such as food, clothing, and other commodities does not increase or decrease. What is inflation caused by? It is caused by the people in middle and lower income brackets. So the people who were given these thousands of dollars in stimulus checks in unemployment now had access money, so they were able to spend more liberally on the goods and services that they normally would not have spent on. They were able to buy them now. And that obviously caused these things to become more scarce. It drove up the demand and decreased the supply, which is pretty much the main reason why we are in this inflationary period. So here's the thing, and this was told to me by a friend of mine who gave me great insight on this. So now that there is inflation, obviously people have an excess in money. They have more than they normally had, which has led to this high rate of spending. The prices of goods and services has gone up. So in order to maintain the spending on goods and services, these people need to get a raise of equal or greater value than inflation in order to sustain these high spending habits. And obviously, if the prices continue to go up and their raises do not keep pace with the inflation, people are going to start spending less. And what happens when people spend less? The prices go down, which is obviously deflationary. So the prices going down, combined with the fact that we have a hawkish Federal Reserve, will cool off inflation and inevitably lead to deflation. So while yes, the Federal Reserve is tightening right now, you have to understand that as the price of the goods and services go up, less people want to spend their hard-earned money on it. And if less people want to spend their money on it, then the prices come back down. Right now, people are getting raises, but they're not going to continue to get 8% raises on a yearly basis to keep up with inflation. Their employers are not going to be able to afford to constantly raise them 8 to 10%. I just don't believe that's something that's going to happen, which will inevitably cool off the inflation. Another thing we need to know is that back in the day when the feds were raising rates, back in the 70s, people like to talk about Paul Volcker raising the interest rates up to 20%. The thing is, back then, the US was in a completely different situation. They did not have the debt they have now, over $20 trillion. In fact, they had, I believe, under $1 trillion. So when the US raises rates, they are a debtor nation, so they have to pay the interest. They are not going to be able to afford to raise the interest rates that much, in my opinion. Obviously, I don't know for sure, but it is unlikely that they will be able to pay that much money in interest rates. The spending on the interest would be too much of a percentage of the larger budget, and they just won't be able to pay for it. Another thing is, I cannot see a scenario in which the Federal Reserve tightens us into a serious recession, meaning into a depression. Could you imagine the Federal Reserve keeps on hiking rates to 10-15% unemployment, and then like people are starving? They just say, nope, hey, we're sorry, no can do. We are just going to bring this country into the Great Depression. I don't see that happening. Should things get bad enough, there is no way the political pressure will be too high and it will sway them to end up slashing rates and maybe biting the bullet of a 4 to 6% inflation, in my opinion, obviously. So in my opinion, while yes, you look all over television, you see people calling for Bitcoin to go down to 12K, 7K, 6K, S&P 500 to drop another 20-30%. But if you look at it, the time to sell was 8 months ago. So I would have loved to have known the market was going to go down 30-35%, but I think it's already too late. The same way people get caught up in the euphoria of a bull market and think things are going to go up forever. People get caught in the misery of a recession and they think it's going to go down forever. The same way Bitcoin topped when everyone thought it was going to go up forever, inflation will top out, even though people think it's going to go up for pretty much ever. I think that it's over for the Federal Reserve. I don't think that's true. If inflation goes up high enough, people are going to cut out their spending and it will end up coming back down. So we don't know when it's going to come down, but we do know that it is likely that it will come down. And when I see the Federal Reserve tightening, right, I think this is a perfect opportunity to dollar cost average. And think about it. If you believe cryptocurrency is going to go up, would you rather buy when the Fed is tightening and people are scared that we're going into the next Great Depression? Or would you rather buy when inflation cools off and the Federal Reserve decides to go risk on again? For me, I know that I would obviously rather buy when the Federal Reserve is tightening, when there's fear. Everybody knows the best time to buy is when there's blood in the streets. And I have not seen this fear in the market in my lifetime, probably. They've been tightening for a couple months now, and they likely are not going to tighten forever. We don't know exactly when they're going to stop tightening. Even the Federal Reserve doesn't know when they're going to stop tightening, because that would depend on the CPI, which we don't know how it's going to turn out. But we do know that they are eventually going to slash interest rates and send these assets to the moon. Good products do well over time, and Hex is a good product. I would be dollar cost averaging now, provided that you have the cash you need to take care of yourself and you are putting money away into less risky assets for your retirement. So to summarize, cryptos, including Hex, cannot be disaggregated from the broader financial markets and the Federal Reserve monetary policy. The combination of the Federal Reserve tightening, as well as less spending by consumers due to the rising prices, will lead to inflation cooling off and even possibly deflation, which will lead to the Feds slashing interest rates and going risk on again. The US economy is also in too much debt to raise to these astronomical rates that they have done in the past. There will come a point where if they over tighten, they are going to have to go risk on again. They are going to have to slash interest rates. Don't get caught up in the misery. Things work in cycles. This too will resolve itself and the inflation will cool off, and the time to dollar cost average is now, provided you can afford it. Not financial advice. Do your own research. Thanks for watching. If you enjoyed, please give the video a like, check out my other videos, subscribe, and follow me on Twitter. Thank you.